Okay, everybody, right, we're coming up to 7 o'clock, so I think it's time for us to start. Excuse me. Okay, this is part 3 in a series of 4. Last week and the week before we did building blocks, we did goodwill, which is the cost that arises when one company buys another. And then last week we dealt with intergroup transactions and what we have to do when there is unrealized profit. We will revisit both of those topics tonight because, surprise, surprise, the example that I'm hoping you've all got to work through in front of you does indeed have both goodwill and it has unrealized profit. So, without further ado, we'll set the ball rolling. And as I've just mentioned, you should have a copy of the data and the blank templates. And if anybody hasn't, if you look to the right, I can't really point on here, or can I? To the right of where the mouse is now, there is a link to Consolidated Statement of Profit and Loss. That is the data for the question if you haven't already got it. Assuming we have, then we'll proceed. So, part 3 in a series of 4, Consolidated Statement of Profit or Loss. For those of you who have looked at this and find it tricky, this was a topic I struggled desperately with when I first met it. So you're in good company. And the good news is, once you get the method and you understand what you're dealing with, it's not that bad really. But it does seem a very forbidding topic at first. As I've mentioned, so far we've looked at preparatory working, we looked at goodwill, and we looked at unrealized profit. What we're going to do tonight, we're going to pull together all the different elements and we're going to put together a set of final accounts. This session, we're going to deal with the statement of profit or loss, and then the final session next week, we'll be putting together the statement of financial position. So let's look at what's going to go into the statement of profit or loss. Top item, again, if you've got the template printed off, you've already got these in front of you. Revenue used to be turnover, also known as sales. Cost of sales, those two together will give us gross profit. Distribution cost of the limited company accounts, everything goes under either distribution cost or admin expense. They take us down to operating profit, or we now call it profit from operations, as I was reminded earlier. We like to change the language every couple of years just to keep us all on our toes. Sometimes a company will invest surplus cash in other companies, either for the purpose of control, which is what's brought us to tonight's exercise, or sometimes just as an investment to make some money. So there may be a dividend received. In fact, there is tonight. That takes us to profit before taxation. Then, of course, taxation. Finally, profit after taxation. And with consolidated accounts, we then have to split that into how much is attributable to the parent company and how much goes to the non-controlling interest, who are, of course, the other shareholders, the minority shareholders in the subsidiary company that has been bought. So, first one is revenue. Now, you recall from last time, there's a diagram that we used. Let's have a look at the data now that we're working from. And we can see that Ginger PLC had gross revenues of 2.34 million, and Baker Limited, no prizes for the legendary figure that inspired tonight's names. Baker Limited revenue of 695,000. Now remember, these are separate companies, although it happens that the people who own Ginger PLC happen to own a controlling interest in Baker. As far as Baker Limited is concerned, they are a separate company, so they have made those sales. And if we draw the diagram we did last week, there's Ginger, there's Baker. Ginger's gross sales 2340. All of it goes to customers outside the group. Now Baker Limited, their gross sales 695,000. But let's look at the notes now at the bottom of the page. And note that, note number C, not number 3, Part C says, during the year, Baker made sales to Ginger totaling £240,000. And that included a profit margin of 20%, and at the end of the year, Ginger closing inventory included 1/6 of these items. Now, we're not worried about the second half of that sentence at this point. What we're interested in is that of the sales made by Baker, not all of it went to outside customers. 240,000 went to Ginger. So, back to the diagram. 240,000 sales from Baker to Ginger, which means that out of the total of 695, only 455,000 must have gone to outside customers. That's where the 455 comes from, deduct one from the other. And so we have 3 elements to the working. Sales of the parent company, sales of the subsidiary, minus the intergroup sales that didn't get sold, that didn't cross the line, gives us 2795. And that's the first, eyes down, your first number. 2795 is our revenue. Now, next one, cost of sales. Now this time it's very similar, only there is an extra working to do because we've said that there's an unrealized profit. Let's go back to the data. Cost of sales for Ginger, 1.4 million. Cost of sales for Baker, 300. But we already know that of Ginger's 1.4 million cost of sales, 240 of that was bought from Baker. So that hasn't come from outside the group. So we know there's an adjustment for that. If we look at the notes, there it is again. Now this time we do need to take account of the rest of that sentence. And I've got a working coming up in a minute to show you how we deal with it. 240,000 included a profit margin of 25%, and at the end of the year, Ginger's closing inventory included 1/6 of these items. At this point, let's think about why it matters. Remember the rule that inventory is valued at the lower of cost or net realizable value. And in this case, we know information about realizable value, so it must be valued at cost. Ginger has paid, yes, 240,000 for those items, but when Baker bought them in the first place, Baker didn't pay 240,000. Baker's got a profit margin of 25% included in that selling price. Now, 25% of 240,000 is 60,000. So Baker has bought those items for 180,000, sold them on for 240. So the 1/6 that are still in inventory at the end of the year, according to the records of Ginger plc as an independent company, 1/6 of 240 is 40. But the cost to the group was in fact 1/6 of 180, which is 30. So we can see between 40 and 30 there's a difference of 10,000. So the closing inventory is worth 10,000 less than it appears to be on the face of it. Keywords: 240, 25, 1/6. So we've got £10,000 of profit, which is included in the inventory valuation as recorded by Ginger. So we're going to need to deal with that. Now let's think, how do we calculate cost of sales? Cast your mind back to the advanced level, the advanced diploma. Wasn't life easy then? Calculating the cost of sales is opening inventory plus purchases minus closing inventory. And that gives us cost of goods sold. So we actually subtract closing inventory to get cost of goods sold, which means if closing inventory goes down in value, that has to mean that cost of sales will increase because you are subtracting a lower amount. Say that again. Any reduction in the value of closing inventory must increase the cost of goods sold. Any reduction leads to an increase. So Back to the diagram. Ginger, Baker, 1.4 million gross purchases, cost of sales. Baker Limited 300,000, all of which comes from outside, so we can forget about Baker's cost of sale. We're not worried about that. 240 that was sold by Baker to Ginger means that Ginger's net purchases from outside the group can only have been 1.16 million. And then we've also got to remember that we've got a £10,000 adjustment to make. If anybody's not happy with that adjustment, do shout up. Sam is ready, willing and eager to answer any questions that you have. Okay, so the working parent company, 1.4 million, subsidiary 300, minus the total of the intergroup sales, plus the adjustment for unrealized profit, because we are subtracting a lower cost, a lower closing inventory to make cost of sales. And that gives us 1470. There it goes into our SPL. So that's 2 down, and from that quite easily our gross profit, take one from the other, 1325. So far so good. Now let's move on to expenses. Distribution costs. There's no sign here that any money is paid within the group. So we just go back to the data distribution costs. We can see that we've got, at this point, I remember we do indeed have a pencil. They don't let me out often. So distribution costs, we've got 100 for Ginger, 45 for Baker. Whoops. All we do, add them together, 145. Next one is administration expenses. Now remember that all expenses have to go into one of these two, and we have got fairly straightforward, but there is another adjustment in this case. Now this time, if we go back to the data, so here we can see that we've got admin expenses of 200 and 135. Those are the first two elements in our working. The other item that we have to deal with, because it's got to go somewhere, is amortised goodwill. So if we look at the price that was paid for Baker Limited by Ginger PLC, compare that with the value of what they bought, and this was the theme of our first talk a couple of weeks back, there's a difference. The difference we call goodwill, and if we look at the notes, it tells us that note B is telling us that goodwill arising on acquisition is to be amortized at a rate of 10% per annum. So let's look now at, first of all, we need to find out what was the price paid. If we look at back to the data, we can see that under the assets section of Ginger PLC, we have the words investment in group company. And that tells us that at cost they have paid £400,000. So element 1 in our working, we know that we've paid £400,000. The next thing we need to establish is just what we've bought. And if we look now at the additional information, Ginger has acquired 320,000 ordinary £1 shares. So 320, we need to make a note of 320. We'll also need to note that Baker's retained earnings at that date stood at £50,000. The way you'll recall from the first session, the way we measure the value of a company is we add up the company's equity. That's the quick way of working out the difference between its assets and its liabilities. So we've bought 320,000 shares, and another element there is that the retained earnings stood at 50,000. If we now look at look at the equity and liabilities of Baker. Oh, missed the heading there. Share capital of, here's Ginger, here's Baker, is 400,000. So we have bought 320,000. 320 out of 400 tells us that our holding is 320,000 out of 400. We've acquired an 80% holding. That's our controlling interest in Baker Limited. So we've bought 80% of the share capital, which doesn't change. That's £400,000, which we just saw on the equity section of the statement of financial position. And at the time we bought it, retained earnings stood at 50,000. We don't choose the figure as it is today because the figure has changed during the year since the acquisition took place. So add them together, 450. On this occasion, there's no share premium that we said to watch out for. Also, there is no mention in the notes of any assets being revalued. Sometimes a question will say assets are revalued for group purposes. So 450, we've bought 80% of that, which is 360. We paid 400, less 360. We have bought £40,000 worth of goodwill. Just pause for breath. Let you do the same. So 10% of 40,000 is 4. So 200 plus 135, which we've already picked up from the statements of profit and loss. Roll them up together, 339 admin expenses, and below that we can now work out profit from operations, which is 841. So far so good. The next item on the list, we notice from the data that the holding company Ginger PLC has received during the course of the year a dividend of 170. Nothing for Baker. So 170 has been received by Ginger, but as with the revenue, as with the cost of sales, what we have to ask ourselves is, did all of that dividend received come from outside the group, or is any of it within the group? So let's take a look now. And sure enough, there is a complication. Where did it come from? Let's look at the notes once again. A no, B no, C no, D no, E no. Item F. During the year, Baker paid a dividend of 37.5 pence per share. So the subsidiary has paid a dividend during the year. Now, next job, therefore, is what we need to do is work out what kind of a value that is. So we have Ginger, Baker, back to, you notice we're back to the same diagram time after time. For me, the day I sat down and drew that circle was the turning point when everything in consolidated accounts started to fall into place, because you can just see where it goes, where it came from, and what it's worth. Baker paid a dividend of 37.5 pence per share. There are 400,000 shares, so that's a total dividend paid of £150,000. Next question is, so where does Baker's dividend go? The answer to that is it goes to the shareholders, of course. Who are the shareholders? Well, 80% of the shares are owned by Ginger PLC, and therefore 80% of the 150,000 is 120,000. So Baker has paid Ginger during the course of the year £120,000 in dividends. The other 20% has gone to other shareholders, and in the group account we don't bother with dividend paid to minorities. The money that goes to them is taken care of as it becomes part of the minority profit share, which is not something we have to deal with separately. So what we've established, if 120,000 goes from Baker to Ginger, total receipts of 170 means that from outside the group they must have received 50,000. And that is the only figure in dividends received that crosses the line. So, dividend received, 170, minus 80% of 150 gives us 50 dividend received. All happy? No questions firing up. I'm hoping this is all making sense. So, that takes us to profit before taxation. Straightforward. Which then takes us on to taxation. Everybody's favourite. Don't we love paying tax? It all goes to the tax man. Sadly, the tax man is not a member of our group. We don't get to keep any of it, sadly. So, from the data, once again, the tax is 120 for Ginger, 35 Baker, 120 plus 35, tax 155. So we finish up with our profit after tax of 736. So we've almost completed our account. We do have one final job to do, and that is that we have to split that between how much is attributable to the parent entity. You need good teeth for this job, you know. And how much is attributable to the non-controlling interest. Tell the boys I'll clean the screen later. So start off by working out the non-controlling interest share. And what we do is we need to look now at Baker Limited, the subsidiary company. That has earned a profit for the year of 180. But that's not the whole story, because remember that there was an unrealised profit. And this related to a sale from the subsidiary Baker to the parent entity. Now, there are different treatments for unrealised profit. As a general rule, if you're not told a very specific treatment, if the profit is unrealised on a sale, you take the profit from the seller's profit. And therefore, 180, take away the 10, leaves 170. 20% of that is attributed to the non-controlling interest, because that's the shares that the parent company does not own, which is 34. So start from the bottom, 736, start with the total. Non-controlling interest is 34, and the final figure is simply a balancing figure. Take 34 from 736 to give 702. And that is our completed statement of profit or loss. I've yet to hear of any arcane method for working out the parent company profit any other way other than as a balancing figure. That's it for the accounts. Just a few points just to summarise, just a few key points. Number one, I can't say this enough. Use the diagram every time. Make it visual. See where it's come from, where it's gone. It just falls into place when you do that. Only items that cross the line will count. If it's anything that stays within the group, then it's not part of those accounts. Unrealised profit increases cost of sales and reduces group inventory. When we do the statement of financial position, obviously we'll deal with that reduction in group inventory at that time. And then also on unrealised profit, it's the seller's profit that is normally the one that is reduced. And if it's the subsidiary making the sale, then that affects the attributable to the non-controlling interest. If it's the parent making the sale, then it doesn't. And finally, attributable to the parent is simply a balancing figure. And that is job done. Unless you have any questions, we shall be delighted to answer them. Or Sam will, and I shall be delighted to sign off in a moment. Did that make sense? Is anybody still there? Oh, multiple appendices. Oh, good. You are all still there. I am relieved. Workings. yes, in response to Alex's question, anybody would like workings, just lodge the request in the chat box, and we'll send them out. And this recording, actually, we will be keeping a recording of this online as well for future reference. Okay. Well, thank you very much, everybody. I just need our technical expert to show me